This podcast is solely for the attention of institutional, professional, qualified, or sophisticated investors and distributors.
Hi everyone, this week we're going to talk about inequalities and in particular housing inequalities. We're going to focus on the case of the US and we will see that this is probably one of the big topics of 2022 as far as the Fed's monetary policy is concerned. In the US, several private institutions are reporting double-digit rent increases over the past year. For example, the company CoreLogic indicates that rents were up 10.2% year-on-year in September. Another example, the company Zillow reported an 11% year-on-year rent increase in October. This increase is completely unusual if one takes into account the fact that rents increase at an average pace of 3.2% per year over the period from 1985 to 2020. And not everyone is affected the same way. In the US, just over a third of Americans rent their homes, but the share of renters was only 15% for the highest income quintile in 2019, where it was 59% for the lowest income quintile. The poorest households are clearly more penalized. The cost of housing is an extremely sensitive topic for households because it represents a very significant burden in the spending. All national statistical institutes do not take into account the cost of housing in the same way. We have seen that this was one of the most important points of the ECB's strategic review because it reached the conclusion that the cost of housing is not enough taken into account in the harmonized inflation consumer price index calculated by Eurostat. In the US, the BLS assesses the cost of housing by measuring the evolution of rents for tenants and the evolution of an equivalent rent for owners. In the end, all rents or equivalent rents represent around 32% of the consumption basket and even a little over 40% of the consumption basket excluding energy and food. But once again, the figures differ according to the household's income. If the cost of housing represents 32% of the consumption basket of Americans, a recent Fed study indicates that this proportion is 43% for households in the lowest income quintile, a share that has increased in recent years, and 27% for households in the highest income quintile. The rise in rents therefore clearly penalizes the poorest households even more. And there are good reasons to believe that the increase in rents and real estate prices will remain sustained for some time. Because after the real estate overinvestment of the decade 2000s, there was rather a real estate underinvestment during the decade 2010s, and the National Association of Realtors estimated in June that there was a shortage of 5.5 million homes in the US, while the housing stock is currently increasing at a pace of 1.2 million per year. The share of homes available for sale is at its lowest level since this type of statistic exists, which means 1965, and the share of homes available for rent is at its lowest level since the early 80s. Thus, the rapid increase in rents is not about to stop. The subject will be at the heart of the debates at the Fed in 2022, in particular because the sharp increase in rents observed by private companies takes about 1 year to enter the consumer price indices and will exert significant upward pressure on core inflation, which could prompt the Fed to tighten its monetary policy. There would be a double motive for the Fed to intervene: the rise in inflation, of course, but also the fact that the acceleration in rents worsens inequalities, in particular as the Fed has indicated after its strategic review that it intends to fight against inequalities. Thank you for listening and talk to you soon.
All comments and analysis reflect CPR AM views on market conditions and its evolution, according to information known at the time. As a result of the simplified nature of the information contained in this document, that information is necessarily partial and incomplete.